On today's episode, we are going to take a look at Disney. They just reported earnings, so let's get started. So first, let's start off by taking a look at this company's stock price performance. Today, it ended the day about 2% down and sitting at about $101. After reporting earnings, the company is down a bit more. After hours, it's down another 2% and is sitting right now about 98.83. If we take a look at this company's high from February, this company was sitting at about $140. So with the current price, this company is close to about 30% down compared to its highs in February. And before we go any further, guys, don't forget to hit that thumbs up, to subscribe, and hit the bell. It helps the small channel out so much, and I appreciate all the support that I'm getting from you guys, so thank you. Also, there are a lot of other companies doing earnings this week, so make sure to post on the comments and let me know which ones you guys want me to do. Alright, so next let's take a look at this company's earnings results. Remember, this is for quarter two, and one thing I want to mention is quarter two is only till the end of March. So in the United States, this only affected about 2 weeks of the quarter, right? Because in the United States, we pretty much closed down in mid-March. So it only affected 2 or 3 weeks of the quarter for Disney. So I do think we are going to take a bigger hit in the upcoming quarters, in the upcoming quarter three, when it's April to June, right? Especially since April has been closed. All the Disney parks have been closed in the United States since April, and there is no real timeline of when they're going to open. So I do think the upcoming quarter is going to be the bigger impact for most companies. So quarter two non-GAAP earnings per share were 60 cents, which missed by 30 cents. One thing to note is this company still provided a positive earnings per share. It's not like the airline industry, right? And I can kind of I would kind of put this with the airline and cruise line industries because they do make a lot of money from their parks, from their cruise lines, and from outdoor activities dealing with Disney. So it is, I think, a good sign that we're at least not seeing a negative earnings per share. GAAP earnings per share were 26 cents, which missed by 47 cents. Revenue for this company was $18 billion, and is up 21% compared to the same time last year, and revenue actually beat by $510 million. At the end of the day, Disney Plus subscribers were 33.5 million versus 26.5 million just a quarter ago. So we saw an increase of about 7 million users. To be honest, I feel like Netflix did take a big Netflix right now is the true winner between the subscriber growth, right? I would have expected Disney Plus to have grown a lot more because one, it's a newer subscription service, so more people would jump in. And second, because of the whole coronavirus and everybody working from home, would even push that even further. ESPN's Plus subscribers went up from 7.9 million compared to 6.6 million just a quarter ago. So remember, those subscriber counts were just compared to a quarter ago, quarter one of 2020. Next, Disney is thinking of ways to preserve cash, and the first thing it's going to do is opting against paying the first half dividends, which is supposed to preserve about $1.6 billion in cash. And $1.6 billion in cash, I think it will help the company a lot, especially throughout a quarter. We're going to see in this earnings call, they mentioned that the results of income loss from the parks being closed was close to $1 billion for the last quarter. So being able to save $1.6 billion will be able to help kind of offset that. But remember, just this past quarter only took effect of a little bit of timeline compared to this upcoming quarter, which is going to have a lot more park closure times. Next, the new Disney CEO, Bob Chapek, says that the company is looking to opening its Shanghai Disneyland Park around May 11th, and they're going to try to be cautious, sensible. They're looking for a cautious, sensible approach. And I think this is going to help out a lot, especially because, right, it's going to teach them what not to do or things to do when they open up back in the United States and when they open up in Europe and when they open up all around the world. Starting with one park, and obviously Shanghai was the first park to have closed down, especially because most of this started in China area. Most of the closures happened there first, and then they trickled them down their way down to Europe and then finally to the United States. So I think it will be a good learning point, not even for Disney, for many other companies as well, to see what kind of stuff they implement. Finally, the last thing we're going to take a look at is the press release that this company gave out for the earnings call. So now let's take a look at some of this company's highlights. First, like I mentioned, revenue for this quarter was $18 billion. Compared to the same time last year, that was a 21% increase. Unfortunately, net income from continuing operations has dropped down. Last year, this company had net income of operations of $5.4 billion. Right now it's $475 million. So that was a decrease about 91%. And you might be like, Jose, that's crazy. The amount of money is making, how much money less is making now compared to the same time last year. But we're gonna see there was a one-time money revenue that came last time that is not coming this quarter. So that's kind of, I know a lot of news articles right now are pretty much hammering this net income dropped down by over 91%, but one of the main reasons was because of that one-time revenue this company collected last year at this quarter. I think a better form of understanding what's going on is taking a look at the cash provided from normal operations. Last quarter, same time last year, this company made $3.9 billion from cash flow from operations. This is cash flow provided from its everyday activities. This year from 3.9, it dropped down to 3.15. So it did drop down by 19%, but it's not that 91% that we see in net income. Finally, this company is still free cash flow positive. It had $1.9 billion of free cash flow this quarter, and compared to the same time last year was 2.7. And one thing I was worried was that this company's free cash flow is only positive because it might have borrowed a lot of money, but we're going to take a look at the cash flow that was not the case. So there, I do see a bit of brightness in this statement from Disney. But like I mentioned, quarter two is going to be the real raid boss for this company. It's going to be the hardest sector, but I hopefully things do start to pick up soon. And then if you guys have been watching my video, you guys have this is pretty much how the impact of COVID-19 is affecting this company. And if you guys have been watching my channel, I have talked about Disney plenty of times and have mentioned most of these. The most significant impact are to the parks, experiences, and products. This is pretty much their cruise lines, their theme parks, and any outdoor experience that Disney has. This makes up a nice portion of this company's revenue. And at the moment, they have closed down all their theme parks, and they have closed down their retail stores, suspended cruise ship sailings, guided tours, and experienced supply chain disruption. Next, another big portion of this company's revenue is studio entertainment. Studio entertainment are like movies coming out in movie theaters, and right now most movie theaters are out of commission. So a lot of these movies that were supposed to be released now are being pushed back to later dates. And then as well as production for new things. Some production in content has also stopped because not many film crews are out right now filming. And then another part is the advertisement, right? This company makes a lot of money from advertisement. And right now with sports being down, ESPN is probably ESPN is not getting a lot of advertising revenue, as well as other portions of ESPN since there's no sports. All right, so now let's just take a look at revenue by segment. And the four main segments that create revenue for this company are the following. Media networks, like I mentioned, this is Disney Channel, and this is all their media. So they have National Geographic, some portion of the Fox network, and they have different networks. So this is the revenue collected from there, from either advertisements, broadcasting. Next is parks and experiences. And this is, again, your theme parks. Then we have studio entertainment. Like I mentioned, this is movie theaters. And finally, direct to consumer and international. And this is where you have Disney Plus, where you have ESPN Plus, and where you have Hulu. So remember, even though Disney Plus is new for Disney also is not new to the streaming platform. They've had Hulu for such a long time. And now out of that $18 billion, a huge portion of it came from media networks. Media networks made $7.2 billion out of $18 billion. So about close to, I wouldn't say 40% comes from there. Parks and experience, and that actually increased about 28% compared to the same time last year. Parks, experience, and products dropped 10% compared to the same time last year, and right now it's sitting at $5.5 billion. Normally, if we took a look at the last quarter, if you guys saw my previous video, this was about 7 billion. Both parks and experience and media networks were close to 7 billion. So we did see a huge impact in parks and experience and products. Next, studio entertainment. Studio entertainments are pretty much flat. Actually, no, it's an 18% growth compared to the same time last year. And finally, the biggest growth of here is directional to consumer. And directional to consumer, same time last year, only made $1.1 billion. This year, it made $4.1 billion. So an increase of over 300% there. And that's actually pretty crazy. Back then, direct to consumer made less than 10% of this company's total revenue. Now it's sitting at about, I want to say about 20 something percent of the total revenue comes from direct to consumer and international. Unfortunately, if we take a look at the income by these products, right? So that was just the revenue. Now the amount of money this company provides. Most of the income comes from media networks. Media networks makes $2.3 billion. Parks and Experience makes $639 million. Studio Entertainment makes $466 million. Direct to Consumer actually takes a loss of $812 million. And if we compare, one thing to though is Direct to Consumer's loss is a lot bigger than it was same time last year. So same time last year, this company lost $385 million in Direct to Consumer. This year, it lost 812. And you're like, Jose, how can this company lose so much more in direct to consumer and international? And one reason, Disney Plus. This company, same time last year, did not have Disney Plus. But if we take a look at the 6 months ended, so this is for Q1 and Q2, if we divide this by 2, in theory, each quarter made up about $750 million loss, which is close to this, what we saw, 812. And that was that. Now this is showing the effect of Disney Plus. Disney Plus is at the moment costing this company some form of operating income. One thing they do mention is even though prior to the closure, domestic parks and resorts volumes and guest spending were higher compared to same time last year. So now let's take a look at this company's membership of streaming services. So first, Disney Plus right now is sitting at $33.5 million, 33.5 million users, compared to a year ago where it had nothing. So that's actually ridiculous amount of growth. Next, ESPN Plus. ESPN Plus a year ago had 2.2 million. Right now it's sitting at 7.9 million. Then we have Hulu. So Hulu's actually been a platform that's been here for a long time, and the total Hulu right now is sitting at 32.1 million subscribers. And one thing that's actually pretty impressive is Disney Plus, in a matter of 2 quarters, now has many more subscribers than Hulu ever had. And Hulu same time last year was at 25.2 million users. So, but one thing they do mention is the average revenue per users collected now is a bit down compared to same time last year. But if you guys do know, Disney Plus, Hulu, and ESPN Plus, if you have all 3, you can actually get them in a bundle. And it makes it cheaper to get this bundle like that compared to getting them individually. And a lot of people are doing that, so it has reduced the amount of revenue collected by a user. Next, let's take a look at this company's balance sheet. And if you guys have been watching my channel, you know this is my favorite thing to take a look at. First, let's just jump in with total current assets. This is compared to September 28th of 2019, so just 6 months ago. So 6 months ago, this company had $28 billion in total current assets. Right now, sitting at $33 billion. So this company did increase its cash and cash equivalents by about $9 billion. Then there were some decrease here and there in other current assets, but nothing else to really throw a red flag. Right now, this company is just building up its cash to be able to survive Q2, and I think that's a very smart move. Next, if we take a look at this company's total asset, 6 months ago, it had about $194 billion. Right now, it's sitting at $206 billion. So an increase of about $12 billion. A huge portion of that, right, about $5 billion, comes from total current assets changed. The others just come from different movements going around in the assets. Nothing really crazy over here. Any red flags that tells me to look at this. It's just $1 million being moved here, $1 million there, $1 million there, $1 billion here. Nothing to really throw a red flag. So there's nothing else to take a look there in the total current assets. Next, I wanted to take a look at this company's liability. In total current liabilities, this company 6 months ago had $31.3 billion of liabilities. Right now, sitting at 35.5. So an increase of about $4 billion in current liabilities. And that to me is not a red flag just because it is the current portion of borrowings. And it just depends on how much money this company owes during this quarter. maybe last quarter it paid a little bit faster, maybe this quarter the payment came a little bit earlier. So these usually fluctuate, as long as it's not a big fluctuation. And for me, that number change is not a big fluctuation, so no red flag, but I just want to mention that. Next, we have borrowing. So this is long-term debt. This company 6 months ago had $38 billion in long-term debt. Right now sitting at about $43 billion. So an increase of about $5 billion in the past 6 months in long-term debt. Again, not that scary. This company's total liability is this company's liability does not seem as scary compared to its total current assets, right? This company has about $15 billion in cash and cash equivalents, so it can easily pay off current portions of borrowing and still have money left over. So to me, Disney's balance sheet is not, I'm not gonna lie, it's not the best balance sheet I've seen. It's not even a perfect balance sheet. It's just an okay balance sheet. It's a balance sheet that shows that this company will be able to survive. All right, so the final thing I want to take a look at is this company's earnings per share estimations for 2021. This company is expected to make $4.44 2 years from now. And with the current, and right now with Disney is a company that I feel is innovating pretty well. It's a company that keeps growing. And a company like that, I personally, as an investor, I get it is different for every investor. For me as an investor, I feel okay. I feel definitely okay paying anything below a 25 PE ratio. So a 25 PE ratio for this current company would give this a stock price of $111. Anything below $111, I personally will feel happy paying. What I would be really happy to paying is anything below a 24 PE ratio. So 4.4 times 20 would give this company a price of about $88.08. For me, that's, I think, wishful thinking. But if this company ever drops below $88 again, I feel like that would be a really great opportunity for me to enter. So now in the comments, guys, make sure to let me know, what are your thoughts on Disney right now? Are you guys buying? Are you guys selling? Are you guys just watching? And like always, make sure to subscribe, make sure to give the thumbs up, and thank you for watching.